I hope my kid isn't listening to this episode. I'm not going to pay for his match. Kya kuch bhi hai? Come on, guys. Get serious. 6,000 a plate.
I don't know. You make that decision. My question is that if you can afford it, why won't you do it? Who are you going to leave the money for?
Yeah, they're asking damn tough questions. I'm supposed to be asking the questions. What is this? I hardly get women on my show. I'm so thrilled to have you here. Our producers also made a point about that, and hopefully we can work hard towards correcting that about it. And I know that for women, transitions is very important.
Especially transitions like marriage or retirement or divorce and stuff like that. So, and you have to make money decisions at that time, right? That probably is a great place where we can add a lot of value.
One reason that I thought that these influencers have also become very popular is because they reach out to a certain crowd. So where do you think the gaps are in terms of perception?
If I just do a Google search of where should I invest, there'll be 10,000 recommendations. You start there, no problem. There comes a point where you realize that you need help. Now it may not happen with everybody, and I'm not wishing that everybody should have that point. And generally when they say, okay, I need help, that is when they start to look out. And as Bhuvanaa said, we have not done a great job of kind of positioning ourselves, saying that if you need help, we are the right people. But at least in that journey, they're able to reach out to some of the financial advisors who are now officially called registered investment advisors. I love the book called Why is God Laughing? It will give you perspectives about a lot of things, including money.
Who wrote that book?
Deepak Chopra.
Oh my, how
It's an amazing book. It puts things in perspectives in a big way.
Yeah. That's good, huh?
Every time you think that your portfolio is not doing well, read that book.
Oh, okay.
Every time you think that your career is not going well, read that book. Why is God Laughing?
Bhuvanaa, Harish, welcome to Paisa Vaisa. Guys, thank you so much for doing this for our listeners.
Thank you
Thank
for
you,
having
Anupam.
us.
Thank you for having us here.
Here we are. Two very qualified people who quit the corporate careers to build an advisory practice. Give us something about, talk to our listeners about your backgrounds. What drove you to take this decision? Bhuvanaa, you first, and Harish will follow.
Sure.
So, my first job was with Tata Motors. I was selling heavy commercial vehicles in interior Tamil Nadu. That was my first job. And I chanced upon financial advisory as an possible profession back in 2004 when I had my own personal life in shambles, personal financial life in shambles, and I had to fix it. And there was nobody back then, right, in 2004, who was a financial advisor. You had an LIC agent or somebody like that.
It's not a good feeling to have your personal finance.
So there was no such concept, I had to fix. I was in loans, and how do I get out of loans? There's nobody to help, right? So then I decided to figure this out myself. I went and did my certified financial planning course, and then I bandaged all the wounds a little bit. And then I realized, okay, it's probably not just me. There are others as well who are sailing in the same boat. I started working with friends, family. I kept my corporate job. I then moved on to working with Sundaram, the Sundaram group. I was part of their Sundaram retail distribution, selling Royal Sundaram products, Sundaram Mutual. And then I moved on to wealth management. I joined a company called Wealth Advisors India. And I was with them during the 2007, 8, 9, financial crisis times. And that was also a very interesting time in my personal life when I just become mom. And so it was all together, very interesting, great learning, steep learning curve. And then I moved to Bombay. I worked with a company called Freedom Financial Planners for about 5 years with Sumit Ved. And so that was largely my corporate career in financial services. And 2016, I chose to try something on my own, more because the office moved from Goregaon to Low Parel. And I'm not going to travel. Who does this in Bombay, right? So I chose to go on my own, and I started as a mutual fund distributor and built a reasonable client base, about 150, 170 clients, and we did well. 2021, post-COVID, we were talking to each other, and we thought there was a good match.
From trucks to financial plans, what a journey. Tall order to follow. What about your background now? Chalo, batao.
So I think we are on the same board. I am a chartered accountant as well.
Yeah. You didn't sell trucks?
I never sold trucks,
Okay.
but I did a lot of training to the team in Tata Motors who actually used to deal with the dealerships to understand finances.
In Bombay?
All across India. It
Nice.
was a very, very large program which was actually headed by the same person who used to head CV business even when Bhuvanaa was there.
Who's that?
Ramki.
Oh, my.
Yeah,
Nice.
so Ramki was
How about
the
that?
head of CV business for a long time. A very
He's a rock star, man.
exactly. So
The
he
heads of
initiated that
business
program.
out there were really something else.
Yeah,
Rajesh
yeah.
Dubey and
Yeah.
Sorry, go on, please, because I've,
Yeah, so there is a common link in that also, which we
Nice.
realized much later.
Uh-huh.
I did a conventional commerce, chartered accountancy profession. The only thing which I did not do was taxation and audit. So I did no tax. I've never filed an IT returns in my life, including my own.
You've done corporate audit, na?
More of bank audits, treasury, etc. But not the conventional ones.
Many we can hear him running a podcast. Okay, sorry, go on.
Yeah, that's a common link again.
Okay.
During the course of my articleship, as you know, there is an industrial training thing which comes up, and I got an amazing mentor at that point, and he pretty much changed my direction towards how I would look at career, and I was pretty much inclined towards financial markets. He basically guided me towards how a career is built in fixed income. I was more on the treasury side, and I'm referring to someone who still heads the fixed income side for now Bandhan Mutual Fund, Suyash Chaudhary.
Nice.
He was my mentor, and
Suyash is like, in fixed income, there's probably
Very
five
few
people
minds.
who are, and he's up there. Yeah.
yeah, and he was as good as that when he was starting off also. He's very young. He's probably just a
He is very young.
year or two
I've
elder
been
to me.
Just hoping to have him here on the show, but maybe I'll get that someday. Please go on. Sorry.
We are also hoping to have him on our podcast.
Okay, yeah.
I've been asking him for some time, but he's super busy with a lot of things. So Suyash kind of built in me the basics of fixed income, macro, etc., which is what I built on for the initial part of my career. So I worked in few organizations, largely in the research and trading space. I was not on the client-facing side at any given point in time. And in 2008, for some odd reason, not that I saw the financial crisis coming, I can say that in retrospect maybe, but I quit my job. And for about a year, I was not very sure about what my next phase will be. So I was 25 back then. And eventually what I stumbled upon was into corporate trainings. So I realized that I can kind of share whatever I know, and I started doing a lot of corporate trainings. So for about a good 8-9 years, I was doing a lot of corporate trainings for all types of financial service organizations. And one of the threads which I picked up there was there's a lot of product mis-selling which is happening in India. There's a lot of target-based selling which is happening in India on the financial product side. So I was always a little uncomfortable about the entire angle of I am recommending you a product because there is a commission attached to it. At some point in time during that journey, when the first circle came to know that I am also in the markets, they would come to me for advice. And initially all the advice would be free. There won't be any concept of making a career out of it. But at some point in time, I thought, why not? So somewhere in 2013, 2014, even before the concept of RIA was mainstream in India, I started telling clients or prospective clients that I'll charge you a certain amount per annum and I'll give you financial advice from an investment point of view. I don't care about how much money you have. I don't care about how you will execute. I'll just tell you this is what is a good scheme or a good stock, and that's about it. So I started charging some annual fees which kept on going over a period of time. But it was never my bread and butter. It was always corporate training that I was focusing on.
Yeah.
At some point, I realized that training is not scalable. You can only do certain number of days a month. And investment advisory started picking up in some way. The breakthrough year was, I think, 2020, the COVID year. COVID year is when a lot of people started realizing the importance of investment advisory, financial planning, putting numbers in place. Some had lost their job. Some had business fluctuations, for example. 2020 was also a breakthrough year for a lot of online content. So a lot of people started doing a lot of online videos and online shows, and everybody was sitting at home. So Zoom became the best friend for everyone. So like Bhuvanaa mentioned that she did a program where I went and spoke on derivatives. There was also someone else who had a channel where I went and spoke on financial planning, and that kind of took off. And a lot of people came to me, but I realized that a lot of them need help on financial planning also. I already had registered with SEBI as a registered investment advisor. That was in 2017. But as Bhuvanaa said, I was not utilizing it fully. In 2020, the thought came as to why not set up a proper, full-fledged, holistic wealth firm.
Yeah.
I knew Bhuvanaa for many years through various channels, and we thought why not collaborate, because the value systems that we had was spot on. We always wanted client to be like our top priority. She had a financial planning expertise. I think I'm fairly good in the investment side, so I thought why not collaborate. So that is where House of Alpha was born.
What are the kind of people you think need your advice and will therefore be willing, to pay you a sum of money for it? And that is the first question. And What do you think these guys are doing wrong that you guys can really correct? Okay, so type of advisor, mistakes they're making.
So I would categorize all the type of investors out there into broadly 3 categories to make it simple. One are all these early beginners. They've just started their careers, early 20s, trying to figure out where they want to be in life. They've just started saving. They've just started investing. They are probably listening to a lot of influencers at this point in time, and nothing wrong about it because that's their first lessons in finance, which is not taught in school and college, unfortunately. They may not need a lot of detailed lifestyle financial planning. I think it will be an overkill for them because they've not even figured out where they will settle down, what their aspirations are, will they have kids, what financial goals they have, nothing like that, right? So that's one category. Then there is an extreme category on the other side where age is not the criteria, but it's more of a lifestyle where they have enough money. And when I say enough money, it is enough to live their life the way they want.
Comfortably, yeah.
Very comfortably. And at no point they have this thought of, will I run out of money? Or is my money enough to live the life I want, for example? So there is this extremely comfortable ultra HNI segment who are almost like thinking of creating a family office, have already done that and speaking to the who's who of investment markets and all that. So for them, the problem statement is very different. They are not trying to figure out what to do from a financial planning point of view. They're just trying to figure out where to allocate their money. Leaving these 2 extremes where we are not catering at this point, in fact, most of the RIAs are not catering at this point, the mid segment is where we come in, where you have started saving, you have started investing, may not be in a very structured way. You have started realizing what your life is going to be. You have started realizing what your aspirations are. And there is a constraint. You cannot just take all the decisions without thinking of money. And whenever there is a constraint, you would need a plan in place. The plan has to guide you what to do. You cannot just take random decisions and regret it later, because the basic principle I personally believe also in is the concept of you only have one life, right? So you want to do it in the best possible way. So that mid segment, which is where you'll probably have corporate employees, SME owners, entrepreneurs who have constraints with money, I think they will do wonderfully well if they do a proper financial plan and then base their investments on that rather than just taking random decisions.
Understood. Bhuvanaa, your thoughts?
So, my realization that you don't just get up one day and sip your coffee and say, okay, let me talk to a financial planner today. Doesn't happen that way. There's usually a trigger. And that trigger is when you have to make an important decision that has a money implication, right? So either, you want to quit your job and do something on your own, or move countries, or, have children, right? So important life transitions, changes, call for a lot of money decisions that come along the way. And when these transitions happen, you're not particularly in the greatest of your mental or emotional balance, right? So especially transitions like marriage or retirement or divorce and stuff like that. So, and you have to make money decisions at that time, right? So that probably is a great place where we can add a lot of value. The frameworks or the very intuitive tools that we manage to build helps client make decisions that will not just help them now get past whatever it is that they're going through right now, but also in alignment with what their objectives are ultimately for their life, how they'd like to live, what lifestyle they'd like to build for themselves and their family. So giving them a holistic, of course that word has been abused a lot. Yeah, I know something that's more futuristic and looking well into the future, not just the near future. That's when people have to make very critical money decisions, instead of trying to wing it themselves, if they reach out and ask for help, we can really make a lot of difference in how they go about those decisions. We've had people come to the financial planning session and completely change the plan that they originally had, saying after they look at the numbers don't lie, right? So they show you the truth, right? And we believe that, you show the truth, people understand.
Yeah, I hardly get women on my show. I'm so thrilled to have you here. Our producers also made a point about that, and hopefully we can work hard towards correcting that. But women and financial planning. I mean, I have done a few episodes in the past, but it's always good to have someone here who can actually talk more about it. And I know that for women, transitions is very important. Marriage, divorce, widow, etc., etc. Just talk a bit about that. Why is it?
So I'll tell you one interesting thing that happened. So I was working and I was quitting my job, about to quit my job and do something on my own on the same thing. And my first client was my boss, right? Which is how things work, right? And of course, I was working for a wealth management company. I was working for a financial planning company that was being taken over by a much larger wealth management company. So he had access to a lot of wealth managers out there. And he himself is a veteran in the industry. He's been around for 25 years in financial services and stuff. But he came to me and said, Bhuvanaa, I'd like for you to, take care of my finances. And the reason he gave me was that I think my wife is a lot more comfortable talking to you than to anybody else. So a lot of male advisors, not anything against them, find it difficult to connect with the spouses, in a way, because they come from a different place, they look at things very differently. And for a family to do well financially, both of them are involved, it makes a lot of sense. So I thought, okay, wow, this is interesting. I could actually use this to my advantage, saying, okay, I can relate with everybody in your family and make sense to them. So women in financial planning, I think, is a great fit. It's an amazing fit both for the clients, because as a family you can openly discuss things, and also for a women as a career choice. This is a fantastic business to be in, because it gives you life balance, you get time to do other things, and you can really do what you want to do, and it pays nothing less. So
Yeah.
I mean, it's amazing. I don't know why there is this mindset of why not women. I mean, I'm surprised that you've not had enough
I
women.
don't. Yeah, I mean, I've been doing this for 6 years now. I've 400 plus episodes, and I don't.
I'll send some women over.
Oh,
Yeah,
lovely! Yeah, thank you so much
yeah.
for that. I think we've had less than 10% of guests. I mean, that's it.
No, there are some
It's
fantastic
very
women
embarrassing
in
for
the
me
industry.
to say that, but yeah, I will try harder. Thank you for that.
Yes.
Your help would be appreciated. Okay, guys, what's the deal with with the whole RIA thing? That's when you have a conversation with normal people, they always feel that RIAs are only for HNIs, or somewhere there might also be a trust deficit, because they feel maybe they don't still know the difference between a fee-only advisor versus someone they meet in a bank, or someone they who's selling them insurance. Generally, one reason that I thought that these influencers have also become very popular is because they reach out to a certain crowd. So where do you think the gaps are in terms of perception when it comes to, say, people who are listening into the show and understanding what an advisor actually does, and any challenges? I mean,
So, talking of influencers, I think they're doing a fantastic job. Like we were talking about it earlier as well. They've filled the gaps that we've not managed to fill, right?
Correct.
Even as financial advisors, I don't think we're doing a great job of marketing our services well enough. Today's people are still coming and asking us, after 20 years in the profession, people are still asking, oh, financial planner, what do you do? Right? So we've done a pathetic job. So coming back to your question, why is that happening? Why don't people reach out? Like, if you're not well, the first thing that comes to you is go to a doctor, right? But when you have to make a money decision, the first thing that comes to you is, okay, let's ask family, friends, let's go to Google, right? So
Correct.
that's your first thing. And I think as a profession, we are only 20 years old, and we have a long way to go, and we have to do a much better job of marketing. In podcasts like this, when they get their reach, I think it helps people make those sensible money decisions.
Sure. Harish?
I think it has a lot to do with the problems they're facing at any given point in time. So if you take an analogy of health, for example, or fitness for that matter, there are a lot of people who go into the fitness way by doing a lot of DIY things. They'll Google certain things, they'll speak to some people, they'll see someone who's probably got fit in the sense that they lost weight, let's say, and they're like, oh, what did you do? And you'll start implementing certain things like that. But the moment it becomes a little serious, for example, let's say you fall sick, let's say you have been detected with cancer, for example, that is when you will not become DIY. I've not seen anybody in my life who would start to cure cancer themselves. I think there is fundamentally something wrong in that sense. They would seek help in that case, and the moment they start seeking help, they will look through a lot of things. They will look through multiple doctors, for example. They'll speak to a lot of people about who are the good cancer specialists out there, right? Same way, in the journey of money also, initially it's all like, oh, I can manage this, I can do this. There are influencers. There is so much content available out there if you go out. If I just do a Google search of where should I invest, there'll be 10,000 recommendations. You start there, no problem. There comes a point where you realize that you need help. Now, it may not happen with everybody, and I'm not wishing that everybody should have that point. And generally when they say, okay, I need help, that is when they start to look out. And as Bhuvanaa said, we have not done a great job of kind of positioning ourselves, saying that if you need help, we are the right people. But at least in that journey, they're able to reach out to some of the financial advisors who are now officially called registered investment advisors. As you rightly said, people don't realize at this point that the only profession who can actually give you proper financial planning as per law is registered investment advisors. So marketing bit is definitely needed. But if they kind of reach a point where they need help, I think that's when they seek out and they reach out to some of us. As you mentioned earlier, for doing a book also, you are not able to reach out to the right RIAs.
Yeah.
It's the same thing. The marketing bit is definitely missing. But even if you're out there, not everybody feels the need. And when they feel the need, I think they definitely reach out to the right ones.
Yeah.
There was a client who was saying this, right? So he's from Bahrain or some such place, and he came through the website. He'd sent a message, and then we were trying to fix a date to talk, and it was Eid, and then whatever, we weren't able to find the right time. And then at one point he said, you know what, you guys are not giving me a time. I've been following up for a long time. Leave it at that. I will just leave a review on Google. I said, okay, if that's what it is, so be it. We haven't even had a conversation. Then finally we got to talk. After that, he's telling me he actually wrote to some 6-7 people. We were the only one who even responded. So that is how good our marketing, our system is. And even for us, he had to do that dumpy of, I will leave a Google review for us to respond. So.
Okay, guys, I want you to use your experience and give some general, for someone who's in his, say, late 20s, started his career, has a couple of years of experience, is looking at a nice 25, 30 year, 40 year growth path in his career, still single, yet to get married. What are some financial planning tips or advice or structure that you would give to this person? And I want both of you all to, contribute. Bhuvanaa, you want to go first? Since you are the financial planning expert, sorry.
So, somebody who's starting off, first things, get some emergency funds put aside, because whatever work you're doing, you could have emergencies, you could have loss of job situations. So about 4 to 5 months of expenses put away is a great place to start. Having your basic term life insurances, health insurances is also an important thing to do. And if you have loans, which are not the home loan, you can leave the home loan. But if you have your personal loan or credit cards, it's a great idea to get rid of them if you have surplus money. And then you can focus on wealth building. So just build these basic foundational things, because what happens is we see people putting away money in SIPs and building some money, and for some strange reason, the roof is leaking, my car broke down, they'll take this money and use it. I mean, utna to you should have insurance and some rainy day money, right? So you can't compromise your long-term investments for the shorter terms. The first thing for young people, prima facie, you have to earn more than you spend, or you have to spend less than you earn. That's like the basic thing, right?
I'd be amazed how many people still don't get
I know. So it's almost embarrassing to say it.
No, it's not. I just feel that, people get into this thing of how to spend less. I'm like, you have to learn how to earn more. And expenditure going out of control is Sorry, go on, please. Go on.
Yeah, so that's the basic thing. That is the raw material. That's your starting point, right? Have some basic budgeting done, have your expenses in control, and with the surplus, then you start doing this step 1 of building an emergency fund, and then buying your insurances, and then paying off all your loans, and then you can start investing. So in the 2030s, like how Harish was saying, you don't have very long-term vision as yet, right? So, but you have income, you have surplus of income over expenses, don't waste it, right? It's phenomenal that you starting this early, and 40-50 years can give you tremendous compounding. You'll be very thankful when you look back at 60 saying, I made this investment when I was 20. So just do, even if it is a fixed deposit, recurring deposit, something, just go ahead and do it. We'll figure out better investment options as we go by, but do not expand your lifestyle and then go and waste all of that money. That'll be the first thing.
You said you have surplus money. I'm assuming you said get rid of credit card debt. Use the credit card. I mean,
you can use a credit card,
that's
but
what I'm
the
saying.
outstanding
Don't let that revolve and stuff like that.
Pay the minimums. Don't do all of that.
Use
right?
responsibly.
If you've carried something forward and pay it off, use credit card very smartly. I mean, it's amazing. I booked my trips, holiday trips using credit card points. I mean, and the frauds you can save.
So
it's very useful.
I'm always glad to hear people say that because there are some who still belong to that apna parents and it's not like I have any problem with that, but the whole cut your credit cards, never use credit cards, always use debit cards. वो advice एक ज़माने में था. I mean, there was a reason why people, your parents would advise it because that is very good advice. Do not mess around with debt. But obviously, if you can handle that debt, if you can use your credit card responsibly, like you said, it's a wonderful tool.
Yeah, of course. I mean, if you're irresponsible with anything, you have a car and you overspeed in that car, then the car is not a bad, innovation, right? You don't know how to use it. It's not the problem of the credit card.
I like that matter of fact way that you put it that way. Hari, get into the investment part here for a reason. It's something that you like, something that you specialize in, the whole equity, debt, passive, active, whatever. What are your thoughts on how to handle that investment part?
Right. But before I go into that on the credit card side, if I was not doing this profession, I could well have been a credit card expert.
क्या बात कर रहे हो? How come?
Absolutely. I mean, I kind of extract all the values from all the cards.
Here we go.
As you rightly said, if you use it responsibly, there's a lot of reward that you can get. I'm not joking. I have an ROI of about 15-16% on my spends. If you do it well.
You're the first person I know who's an advisor who says that he earns money on spending.
Absolutely.
That's theoretically wrong, but I get what you're saying.
I don't spend to earn more, but whatever expenses I anyways have to do, I would rather do it in a planned way through certain credit cards and ensure that I get some benefits out of that.
I'm going to take those tips.
Yeah, I know that's what. I'll try and do a separate, session with you on maximizing of credit cards because I know, we've not covered that on our episode, but let's get to the investment part.
Now, when it comes to investing, I think the first thing which I want to tell everyone through this platform is stop having this fear of missing out when it comes to investment products. There are a lot of young people out there who are spending a lot of time and energy unnecessarily on trying to figure out what is the best product out there or what should their portfolio have in terms of different product mix. They could be chasing some exotic stuff like, for example, cryptos and all that. I have nothing against it, but I'm just saying that if it is not your core profession to build a portfolio, don't waste too much money and efforts into that. You should always try and focus on trying to increase your core income. In the pursuit of wealth generation, unfortunately, in the last few years, people have started chasing returns. That's not an investment advice, but since I've seen so many youngsters spending a lot of time and efforts on trying to figure out what's the best product out there, which is not their core capability, I think it's kind of running on a treadmill. So you focus on your core, you try to increase your income in whatever way you can, and then invest whatever you can save. As simple as that. As Bhuvanaa said, try and save as much as you can is number one. It's like trying to say eat healthy in the fitness regime, super difficult. It's like saying cut your losses when you're trading, super difficult. Same way, save as much as you can. Once you start saving, and if you're kind of investing for a certain goal, the broad principle I would give is classify your goal into two buckets. Up to 3 to 4 years, more than 3 to 4 years. Simple. I'm trying to keep it as simple as possible.
Yeah.
If it's up to 3 to 4 years, just put your money in some fixed income product. It could be fixed deposit. It could be a debt mutual fund. Don't try to complicate things. Don't try to time anything. If you're investing for more long term, if you're not sure about whether you need the money in 3 years, I can invest for 5 years, 8 years, 10 years, or if it's your retirement corpus, the only asset class that you should have is equity. Simple, straight, nothing else. No real estate, no gold, no crypto, nothing. Just stick to equity. If you're not sure what equity products are good for you, put your head down and put every money you have in an index fund. Don't do anything much. You will not regret. After 25 years, most products would not have beaten the Nifty index or the Sensex index in India, or for that matter, any country. Very few products will beat the index in the long run. You will realize it only after spending many years, and I've spent 20 plus years. Just stick to index fund. Keep on investing. Put your head down and do nothing. At some stage, once you have reached a corpus which is good enough, and whether you know whether it's good enough or not is again financial planning, you can take some extra risk. You can go into a zone where you create what is called a satellite portfolio. So create your core through equity. Satellite portfolio is where you do some musty, you can okay, let's dabble into crypto, let's dabble into startups. It's that money, even if you lose, your overall financial plan is not hampered. Your child's education is not a function of this portfolio. You don't want to have a situation where 15, 18 years down the line, you tell your daughter, I was planning to send you to, let's say, US for higher studies, but I invested that money in crypto. That's gone to zero, so you will study in UT. You don't want a situation like that. You want your core portfolio to be as steady as possible. After that, if you have some surplus, you have to plan it. You can dabble. Till then, the only advice I say is stick to index funds. Please don't have this fear of missing out about any product. Stick to basics. Index fund is good.
Yeah. And folks, what Harish, the whole satellite part, just remember what Harish said. This is money that you can afford to lose. Okay. You don't, like he said, you don't want, that you kept a fund for your daughter to study in the US and she's, nothing wrong with Uti, by the way, folks. Let's not, I don't want to get cancelled out there. But just get the point that Harish is saying, that you don't want to put your money in a place, where you got an expectation for it, a target for it, a goal for it, and boom, that 90% ud gaya and you're left with something in your hand, which is my next question. Mistakes, fear of missing out, and the kind of stuff that you see your clients making that, that just makes you wonder, what are these guys thinking? I want to talk about stuff that our listeners should not do, stuff that you have seen your clients doing, and, very obvious mistakes that you wonder, bhai, what was this guy or this person thinking? Can we talk about that for a while?
Okay, so about... Where do I start?
Okay, there are so many of them. My favorites have always been, people who say long-term goals and then land up putting in a, they put in a equity small mid-cap fund and then they sell out after 2-3 years. After saying, so anything that you guys say behaviorally, product-wise or anything, that you should not be making such basic blunders.
That's a very classic one, that when you start off with a plan, you have a plan and all, but then you forget the plan along the way, because like I meet people who say, yes, I got my financial planning done. Say, when was this? I think 2015 or 16. Like, okay. So it's like saying, okay, I ran the Tata Mumbai Marathon and then I'm fit for life. Aisa thodi hota hai. So you have to come back to,
How often do you think is a good review period? 6 months? 1 year?
1 year is good. One year is good enough. It's like a healthy lifestyle. You don't just do it once. It's an adoption that you make to change things. And once you have a financial plan perspective, or you look at things in the long term, you look at the cost effect of money decisions that you make, then how you deal with things completely change themselves. One very important thing that I wanted to share was, so goal-based financial planning, we've done it for many years and most people do it. Okay, plan only for children education or the wedding, right? And then forget about the rest of the things. So you don't do these silo things. You look at life holistically, totally, right? So in our way of doing financial planning, what we call as lifestyle financial planning, what we realized is while okay, you have a child, you'll put them to college here. It's not that, you don't have a plan, they won't go to college about. It's nothing like that. You will put them through college, you will get them married when the time comes. But at what cost? Right? So the realization is that clients want simple things. They want very, very simple things. That I have a certain lifestyle. I live a good lifestyle. And what I can't do is that compromise on this lifestyle. I can't go down. And if I'm driving a car, I can't take local transport. Right? If I usually take a flight to my hometown, I can't go by the train. So lifestyle compromises are something that people don't want to do. But at the same time, they're also worried, can I sustain my lifestyle? I'm aspiring for a good lifestyle. I'm living a good lifestyle. But when I retire, can I sustain the same lifestyle? Is it possible? Is there a possibility that I'll run out of money? Can I? So they're always spending with guilt, right? So instead of looking at things in silo, you look at more holistically. So we have one single framework. You take any decision you want. You send your children abroad. You get them married at 6,000 rupees per plate dinner. Yikes. Right? So you do all of that, no problem. But will your money last if you take this decision? Right? Every single decision that they make goes through this single framework. Not having that perspective. So most wealth managers, they look at, okay, this money is there, go put it there, change this, PMS karo, ye karo. But when you don't know what you want the money to do for you, there's no way you're going to know what to do with the money.
Sure.
Right? So get that perspective. Put the horse in front of the cart. Figure out what life you want to live, because money is only incidental in the process. Right? Why you're doing this whole thing is to live a good life and ensure that your money, finding that balance. Like today, it's not today at the cost of tomorrow, nor is it tomorrow at the cost of today. It's finding that balance.
I hope my kid isn't listening to this episode. I'm not going to pay for his match. Yeah, kuch bhi hai. Come on, guys. Get serious. 6,000 a plate.
I don't know. You make that decision. My question is that if you can afford it, why won't you do it? Who are you going to leave the money for?
Yeah, they're asking damn tough questions. I'm supposed to be asking the questions. What is this?
No, my question, this also happens. Like we
you're
see
right,
people,
you're right.
So they come back at 80 years and saying, oh my God, why do I have so much money when I could have all my life always traveled only business class? Yeah, why did I not do it?
Man, that is tough. Yeah. I have no idea how to answer those questions. I mean, it's again something that I can't imagine. But you're right. I mean, the purpose of money is for you to enjoy a full life, a happy life, and and if you're kind of curbing that, then obviously there's something wrong.
We've had somebody come to office the other day, and this lady's just lost her husband, and her son has come, and they're trying to figure out, right, what's lying where and all this stuff. And they suddenly realize there's a lot of money, right? And his mother is asking a simple question to his son. I'm wondering, why was dad so conjuice? Yeah.
Oh, yeah.
We could have gone out on those holidays. He could have got me that diamond necklace. Yeah. Why didn't he do that?
Oh boy.
Right? So
that's a tough question.
Yeah.
That's a tough place to be in.
Yeah.
Harish, your thoughts on what Bhuvanaa said? Any examples that you have?
Yeah, so I spend a lot of time seeing through the investment portfolios of many clients and prospective clients. The single largest mistake I've seen is having too many schemes and too many stocks.
Oh yeah.
There is a big issue out there where I've seen portfolios with 43 mutual fund schemes and 87 stocks. What people don't realize is that you can never ever create wealth in that sense. If the idea was to generate great returns, it will not happen because you over diversified your portfolio. It is totally okay to have a long-term, large, bulky portfolio with two schemes also. There is a big fear that people have that just because I have more money, I'll have to diversify. The question is, what is more money? If you have 10,000 bucks to invest, you invest in two schemes. Does it mean if you have 50,000, invest in 5 schemes? Doesn't make sense, because if I have 50 crores, I can still have only 3 schemes. So people just keep on over diversifying into various products, which I think beats any possibility of trying to generate whatever returns they were generating. So the only advice I would give to anybody is try to keep a very simple, small portfolio, and that also can work.
That stuff never gets old. I find it hilarious. I mean, there's a thinking somewhere that the more places you invest in, the more returns you will get. And I'm like, guys, the richest guy in India has pretty much just one stock.
Yeah, that is why he's the richest guy.
Yeah, I mean, anyway, what works for him, I think generally, I'm not saying that you should also, if you make your business, that's fine. But having 100 investments versus having 10 doesn't increase your chance of increasing the rate of return. I mean, everybody is obsessed with this whole thing about improving the rate of return, which is fine. No issues with it. But I don't think there's any study or data that shows that having 100 mutual fund schemes or 100 stocks means कि तुम्हारा 12% का साल का 15% हो जाएगा. ऐसा कुछ नहीं है ना. Just
it's the other way around. It's the other way around. The more you have diversified, you're diversifying risk also, which means you will go towards risk-free rate of return.
Yeah.
So the idea is, I think it's again the fear of missing out. So they have a, let's say, 12 stock portfolio. Someone comes to them and says there's a stock which is not in their portfolio and that's going to be the best. So you add that also. Then you add something else. What you don't realize is, let's assume you have 50, 60 stocks and the largest exposure in that portfolio to one stock is, let's say, 2%. And that stock turns out to be the biggest multi-bagger in the next 10 years. But you only have 2%. Yeah. It will not make any material difference to your wealth in that case.
The very common trope is that clients come and say, I've done stocks, I've done mutual funds. Abhi kya karu?
Oh, they want more excitement in life, is it?
Yeah, they do. In terms of stocks also,
what kind of answer will you give? What will you do? What, you want to go bungee jumping or something? That's not even the rate of return, right? And what is the deal out here?
They just want to be having some conversation points also multiple times. So when they're in a group and they're discussing about some stock, they're like, I also have it.
This ego trip, man. It's a
very common motivation to invest in certain products because it's the trend of the season at this point. And that they do with stocks also. They keep adding stocks because they want to have some talking points. Again, when you add stocks, the only thing which again I don't understand people doing is they will cut a profit-making position and reinvest that money in a stock which is not doing well and thereby kill everything possible. So I tell this, if you're not sure, start with 100 stocks. Okay, you're not sure. every year just kill the stocks or sell the stocks that are not doing well, reinvest the money in the ones which are doing well, do it for 10 years, you'll have probably 6 or 7 stocks left that probably has the best chance of doing well in the next 20 years. It's a very simple way of trying to create a concentrated portfolio. But we always sell the winners and reinvest it in the losers.
Boy, this stuff never gets old. Okay, Harish, so you've got a pretty deep experience in debt. Let's get to the last few parts of the show, which is outlooks, equity, debt. I want to start with debt, okay, because nowadays if you go to a party between the equity fund manager and debt fund manager, the debt guy is going to get more attention. Shayad thodi gali bhi pad jaye because of the tax change. Yeah. But your outlooks, let's start with debt, then go to equity and,
Sure.
that way.
So debt as an asset class is a less volatile, range-bound returns kind of an asset class. So from an expectation point of view, we are not talking about debt trying to give you a 20% CAGR. So we are saying whether it will give a 5-6% CAGR or probably in a phase you will probably get a double-digit rate of return. So it's a tactical asset class in that sense. So if you want to play it, you play it using the interest rate cycle. What I believe is that we have peaked on the interest rate cycle, be it globally, where probably Fed is one hike away from pausing, or be it in India, where we've already paused in the last monetary policy meeting. What essentially now it means is that the interest rates have peaked, and over the next 2 to 3 years, we'll probably have some softening. And from a positioning point of view, you can use this opportunity from a tactical play and invest in probably the 4 to 5 years duration bucket, which is my favorite bucket at this point in time from a yield curve point of view, because that's where the value is. Beyond 4 to 5 years, the yield curve is very kind of flat. So you don't have an opportunity of trying to invest in 10 years and earning some returns. So on the fixed income side, if you have a core long-term portfolio, just stick to it because you will get a typical 6-7% compounded without the tax benefit now, unfortunately. Yeah. But in the tactical side, if you do have some money for the next 3-4 years, you can just invest in this 4-5 years bucket and probably get 9% or even closer to a little higher than that if interest rate plays out the way it is going to be.
And you don't want to do credit out here. You just want to do duration. That's it.
Credit is a very specialized play. So if you want to play credit, you need to understand a lot more about how those sectors work.
Let's not go there.
At a generic level, you can take credit risk if you wish to, but stick to those AAA credit risk rather than go into AA, single A, etc. Because that's where a specialized play will come in.
Got it. Equities?
Equities near term is going to be murky. I really do not claim to know what Nifty or equity will do in the next 3 months, 6 months, etc. But what I'm seeing broadly as I read through a lot of news and data is there's an underlying significant shift happening in the overall economy. India is changing in multiple ways that is not being captured in data at this point. There's a big digital revolution that is happening now. There is a lot of income being generated from career sources that we were not even aware of 5 years earlier, right? So there's a lot of income being generated in this bulging lower middle class segment, and that is going to come out in a compounded way over the next many years. We are suddenly seeing a tech revolution in the truest sense in India over the last 8 to 10 years. We have been hearing about India being a tech powerhouse right since early 90s, but what were we doing during those days is just about being a IT services hub, right? Where we were trying to do some cost arbitrage on the labor side. That's what a large part of Indian IT services was doing. Sure. But last 8 to 10 years, you will see the young entrepreneurs using technology and changing our daily lives.
Okay.
The fact that we are doing this, the fact that we are going to put this out on social media, the fact that we will probably take a order from Zepto, this and that. There's so much of tech underlying our daily lives today, and that's going to make a lot of change dynamically for this country overall, and that I think will be the biggest driver for the next 20-25 years. So I'm also in that camp who believes that the next 2-3 decades easily is India's in terms of the global growth of things, and you have to be in equity in this game, and you will have to ride it through equity in any form.
And the way to play it is generally a Nifty index fund should,
If you are a beginner, index fund is good enough. If you have some stock views, some stocks will do. But as you go deeper, there are multiple ways of playing it. But if you just want to be in this game, just an index fund will work. And I don't think you'll regret that.
Got it. Bhuvanaa, any closing thoughts? Anything that you want to add in out here or anything else, in terms of a message to our listeners on financial planning, good habits, anything?
No, this is amazing because like if Harish says 20-25 years is going to be India's, we have to be very fortunate that we still have about 20-25 years of work life, right? I'm presuming that's what you're your listeners also have, or that's their demographic. So somebody who's 60, 70 probably are thinking, why didn't this happen when I was earning, right?
Yeah, what to
Bad
do?
luck. But good for people, and now is when you can maximize. It is like what the baby boomers enjoyed in the US, and you don't want to miss out on this, and don't be stupid. Don't do ridiculous mistakes. Just stick to the basics, get your insurances in place, have an emergency fund, and start investing equities, whatever other investment options you're comfortable with, but equities will play out very well. And stay off bad loans, bad habits, so
Can't
it's just as simple as that. It's very commonsensical, right? I don't know what
Can't
more
get
to
simpler
say.
than that. Books. Anything that's the final question to all my guests on my show. Any recommendation to our listeners in terms of books or anything you're watching, seeing, anything at all?
I've just started reading your book.
Oh, thank you so much.
Yeah,
well, oh my God,
Diamonds in
okay.
the Dust, yeah.
This is.
So,
Please pick up the Wisest Towel. Okay.
not
thank
the
you so
Wisest
much.
Towel, the other one.
Victory Project.
Yeah.
That was sort of, the Victory Project, whatever. Okay, Harish?
A lot of books, obviously, I would want to recommend, but if I were to pick a couple of them, I would probably pick the eternal favorite, Rich Dad Poor Dad. I think everybody should go through it at least once in their life, at no matter what stage you are. It kind of gives you the basics of personal finance very, very well in terms of wealth generation. I love the book called The Snowball. It's a beautiful book on how Warren Buffett created his wealth. So I'm not talking about follow his path, but there are certain snippets in that book which, if you can implement, you will do a great way in terms of managing your money. And I think the last one, which is a little off there, is probably a book which I recommend everybody reading, is Why is God Laughing? It will give you perspectives about a lot of things, including money.
Who wrote that book? I haven't.
Deepak Chopra.
Oh my, how
It's
about
an amazing
that,
book. It puts things in perspectives in a big way.
Yeah? That's good, huh?
Every time you think that your portfolio is not doing well, read that book.
Oh, okay.
Every time you think that your career is not going well, read that book. Why is God Laughing?
Well, there you go, folks. Four recommendations. The Victory Project by Saurav Mukherjee, and of course this gentleman sitting here.
Yeah.
Rich Dad Poor Dad by Robert Kiyosaki, if I remember the name correctly.
Yes.
Then of course there is
The Snowball.
The Snowball. I've forgotten the author, but it's a recent book. I know that it's been written in the last couple of years. And of course, Why is God Laughing by Deepak Chopra. 4 books. Amazing. I mean, that's enough for you to take care of your weekend and the rest of the month.
IVM.